Hello, everybody. It's been a while, but we're back. This is an Equi market call. We're going to be trying a new format today. We're going to be doing shorter and more frequent calls. For those of you who've been following us for a while, we typically do long conversations about what's happening in markets to prepare you to best ride out the storm. But for now, why don't I get started? I'm Tori, CEO and co-founder of Equi, and with me today, our illustrious Chief Investment Officer, Itai. What do you got in store for us?
Lots of things. And, I try to put it a little bit more packed in a way for us to kind of cover in more of a 30-minute time span versus what we used to do, which tended to be a little bit over an hour. Let's see if we can actually make this 35 minutes. It might be challenging. To be fair, I really miss these market calls and the format of doing them together. And I will also say, I know I say it all the time, but we live in very interesting times. We have been living in very interesting times really since COVID. And the times just keep getting even more interesting. So we can cover some crazy stats today. And we'll talk over what the market's been doing over the last 6 months and really since the kind of 2022 market bottom, and where we stand today and what we could potentially expect for the future.
Perfect. Yeah. And I'm looking forward to experimenting with the format. We've been getting feedback from everybody. We might do, today 30 minutes, but we want to also experiment with 5 minutes, 10 minutes, see what actually works for people. So as you're hearing this, give us your feedback, shoot me a text, shoot us an email, founders@equi.com. We're here for it. So with that being said, let's kick it off.
Okay. So today, July 11, 2024, one of the most interesting observations really is that this has been the most concentrated bull market since the dot-com era. I know when you're watching the indices every day, unless you're invested in small caps, then my condolences to you. That hasn't really done much for a while. Markets just keep making a new high after a new high, but there's a lot of interesting things that happen kind of under the hood, and I'll try to cover a little bit of those. Let's talk about this year. Since it's been a while since our last update, Max 7, again, continuing an unbelievable, almost the rest of the S&P just about 7, and small caps went red for the year again. So again, discrepancies we've seen. Typically in a normal bull market, small caps tend to lead the markets actually. So this is again, continuing theme since 2022, really.
Very typical.
Now, here's another way to look at this. I thought this was fascinating. These are all the S&P 500 companies, and you can see how they're doing versus the rest of the index. So you can really see that very few companies are actually beating the index. And you can see what's really driving it. NVIDIA, SMCI, that's of course crazy levels, but the number of companies that are actually underperforming and negative for the year is just stunning, given the fact that the index is just continuing to rise. So it's one of the largest discrepancies, most narrow, in fact, in history in some instances. Here's another way to look at this. The bigger getting just bigger and continuously bigger.
Wait, just to make sure we understand what we're looking at here. So we're looking at, so on the last chart, totally makes sense. We're seeing how that midline is actually moving further and further to the right, meaning the divide between the haves and the have-nots in the S&P 500 is getting wider and wider and wider. And the haves it's getting narrower and narrower. So that's market breadth that we're talking about, right?
That's right. That's right. So what you're seeing in this chart for the year is by what percentage does any specific equity underperforming or overperforming the S&P 500 index broad average? So in a perfect world, it should be right in the midpoint.
Right. Makes sense.
But you can really see that 20% of the index is dragging the whole thing up when about 80% of it is dragging it down, which is quite rare.
Right. Okay. So now on this next slide that you were showing, this is instead looking at concentration, or is this what are we looking at here?
Yeah, so this is the concentration. So you can see how big the top 5 companies in the index are. Almost about 30% of the S&P 500 right now is 5 companies, which is another way to look at concentration. So again, this is the largest concentration since 1964. Curious enough, the mid-60s was a period where we entered a pretty substantial lost decade that lasted for quite some time. So not calling this is necessarily going to happen. There are other measurements we can look at a little bit later in the presentation, but again, typically concentration and very strong concentration is something to keep in note, keep in check, because a healthy bull market tends to just have a lot of participation, a lot of companies in the economy. We just have very few, and the bigger are getting bigger. So that's something that I didn't think would happen, honestly, when I was looking at this in early 23, because you are going by kind of historical average, and we're already at a pretty extreme point at 24% in 2023. This has gotten a lot bigger into 2024, and really, it's almost a 7-year high in concentration.
So am I right in saying, then, looking at this chart, that this is the most concentrated the market has been since even the 1960s?
That is exactly right. Since 1964, to be exact.
Wow. Okay. So yeah, the extreme can always get more extreme, especially when you're setting new market records.
That's right. Here's another way to look at this. I told you I'm going to blast you with some stats today that's going to potentially make you feel shocked somewhat. Because again, these are not the things you see every day from the media or from kind of the just clothing pricing S&P. I thought this was a really interesting stat when you're looking at the .com bubble. Top 4 names that come to mind with crazy performance is Cisco Systems, Intel, Microsoft, and Oracle. Those are really the darlings of the .com era. And the 5 years through the .com peak that happened in March 2000, the average of those stocks was around 1,800%, so 18x in your money roughly, until the bubble peaked, and then everything went down 90% after that. But nonetheless, that was a crazy ride if you wrote that correctly. However, NVIDIA this time did 3,000%. So NVIDIA massively outperformed the prior .com type of records so far, where a lot of that performance really came over the last 12 months.
Wow, so almost double.
Yeah, it's really wild. And when you're looking at NVIDIA versus Cisco, so those are the two key darlings, right? NVIDIA today, Cisco Systems back then. So this is the 5-year run into a top, so you can see the difference, how much more NVIDIA has outperformed Cisco, which honestly I didn't think I would see in my lifetime again, but this is just absolutely crazy. A way to look at this in a relative term instead of absolute price term is what percentage of US GDP this company become. So the day the stock market peaked in March of 2000, Cisco was 5.5% of the entire US GDP. Last month, on June 18, NVIDIA almost became 12% of the entire United States GDP. So
that's shocking.
It's just stunning. It's just stunning. Like we're witnessing this. So when people are saying, but how is it possible the stock market continues to go up when most stocks are going down? It's because when one company becomes 12% of the entire US GDP,
that is insane.
That can drag.
That's a stat I hadn't heard before.
Yeah, so I put that together as it became the most valuable company in the world on that date at 3.3 trillion. It massively did that. But at the same time, the multiple is 41 times revenue. The biggest question, of course, is, are these expectations going to be met, right? Because when you reach these type of valuations, a lot of optimism has kind of been priced in, and that's really the biggest question. So just another way to look at this. I put a bunch of different ways to look at the kind of like breadth concentration and the market dynamics. So both on the kind of NVIDIA side and how these things look like. Here, what you're seeing is, if you can look at the market in this kind of way, where you have the S&P 500 price, and then you have the S&P 500 equal weight. So let's imagine a world where every stock was equal. NVIDIA was not 3 trillion, and Home Depot was a few hundred billion. Let's say everybody was the same. So it's kind of like the House and the Senate almost, right? So in the Senate every state has equal 2 senators, right? So let's imagine that versus more like a house where every state gets the kind of benefit of its population. There are periods of time where the S&P 500 equal weight would outperform the real S&P 500. A lot of times, that kind of happens as the market starts a new bull market. And there are times where the market gets very concentrated and the S&P outperforms the equal weight by quite a bit. So what's interesting is we are at exactly the same ratio today, with a 13% difference or spread between S&P and equal weight S&P outperformance. Last time we saw that was exactly in March of 2000.
That's so interesting. Okay, so there's this market dynamic of like, equality near the bottom, right? It's like everyone's suffering equally, and then massive concentration towards the top, generally before we see, the market rolling over. Is that is
It
that
is
roughly
kind
what
of
you're saying?
interesting because we have seen this dynamic play out right before COVID. We've seen that dynamic play out in before the last correction, and we actually did see that as well around '07, but not to these extremes. We're right now
Right.
reaching now like the dock
Oh,
points.
one extremes. Yeah, yeah, makes sense.
So another way to look at this, so I kind of came up with a bunch of ways. How many stocks are actually beating the S&P 500? The percentage of stocks that are beating the S&P 500 has reached record lows, actually exceeding what you see here in 98, 99. So only about 25% of stocks in the S&P 500 are actually beating the S&P 500, which if you think about it, it should be 50%, right? If things were kind of random. And historically, it is much closer to 50%. However, this has been the narrowest market on this measurement in
Wow.
history.
That's wild. Wow. Okay.
And
So what
then
is yeah, go ahead.
lastly, this is my favorite because I like correlation. This is the correlation between the S&P 500 and the stocks of the S&P 500 actually going up or advancing. So right now, there's actually very low correlation between the S&P 500 stocks going up and the actual price of the S&P 500.
Okay. So basically what you're saying is that the S&P 500 stocks can be going down, right? Meaning the number of constituents in the index are losing money, let's say, but the index itself is moving up.
Correct. And
Are you familiar with the Hindenburg omen?
yes, that's
Is
kind
that
of
is that is that a measure of this?
not really. The Hindenburg is more of a trading signal where it's saying, okay, if you have this type of scenario where we have this amount of stocks going up over around a 52-week high, and then there's kind of a move lower, it can trigger kind of like a potential market top. Kind of interesting signal altogether because every market crash had a Hindenburg omen before it, but not every Hindenburg omen can trigger a market crash kind of thing.
Right. But it's basically talking about there's underlying weakness within the market that's not showing necessarily in the overall index.
Exactly.
Right. So that's what kind of made me.
It's very similar, yes, because the Hindenburg omen is a measurement of breadth. However, we've been in a very interesting world where this just keeps going, and it has kept going for quite some time and really accelerated in 2024. But again, what I find interesting is the last time correlation broke like this was in fact in the late 90s. And this time we actually went more extreme. Correlation went even more. So there's only a 69% correlation between the stocks of the S&P going up and the S&P price going up, which doesn't really make sense.
Yeah, that's strange.
I mean, it does leave sense if you realize that NVIDIA can become 12% of US GDP, and it's enough to drag things up on its own, right?
Right. So where does this leave us now?
So a lot of it has to do with, earnings, and really the way to think about these things is that there's a new technology, right? In this case, AI. We don't really know what it's going to do and how it's going to play out. And there is this idea of expectations and reality. And right now, we don't know the reality yet, but we have expectations. So let's look at the .com here, 2001. You can see that the earnings growth per year to maintain the ROI and the forecast that was priced in kind of like as the bubble was going on was about 22 to 24% growth. And the realization was actually negative. And that caused a massive mismatch between expectations and reality. And the NASDAQ ended up going down almost 90%. People don't know this, but 80 to 90% decline between 2000 and 2002. So that was massively painful for a lot of people. Right now, we're pricing in 16% ROI and 16% growth year over year for all these hyperscaler companies, which are really the big tech. The reality is that going to play out? No one knows.
No one knows, right?
And right now we've built in a lot of expectation. How does that play out? A lot of it depends on that. What I can tell you right now is when I look even at type of um, forecast from Goldman Sachs, NVIDIA's growth was just stunning. Here to
Right.
the left chart, those are real numbers, but we are seeing it slowing down. And into 2025, it is supposed to slow down a lot from where it is today. The question is, are these numbers even real? And are they going to have
Right.
competition? And
Right.
is technology viable? Or are we just overbuilding something that we don't really have the demand for? No one really knows the answer to that. Kind of uncharted territory. History shows, though, that when things get really hyped up the way they are right now, typically that doesn't end very well. But I'm not going to make a call because you never know how long that can last. And it has lasted longer than I expected. Can NVIDIA become 50% of US GDP, 25% of US GDP? Like, who knows?
Right. Who knows? I mean, there is precedent in other countries, obviously much smaller ones, for a single company to make up a large share of national GDP. But obviously, for that to be the case in America is unprecedented. Now, one question I have for you, and maybe this is more of a thought exercise, which is, there was an interesting article recently about the AI bubble and how, venture has poured, I think the stat was something like $600 billion into all these AI companies, AI startups. Like it was just crazy numbers.
Mm-hmm.
Obviously, the lion's share of this is probably going to the companies at the top. And I wonder and also I wonder if that might just be including dry powder for like AI funds that have been raised. Because if there's a $1 billion AI fund, that probably counts towards it. But what's interesting is it was talking about how now we need to actually see revenue coming as a result of all the money that's being poured into it. And that just hasn't borne out. There's a few examples, but the vast majority of these AI companies are not actually generating any revenue. And so the interesting thought is, is a lot of the NVIDIA sugar rush being driven by the amount of venture that's been poured into it. But that could sustain it realistically, potentially even longer, because the size of the venture market is just so much larger than it's ever been previously. And so I'm curious if you have thoughts on that. Because again, this merging of like private and public markets, they interact now to, I think, a much greater extent than they have historically.
They have, but my initial thought on this is that the public side is still so much larger, right?
Yeah.
So you're talking about 600 billion, things like that. Remember, the market cap of NVIDIA is over 3 trillion. And that's the single company in AI. Now, there's a big question whether or not there's real innovation in a lot of these companies, or they're just layers on top of something that don't really innovate much and are just trying to catch, some capital in the hopes that they can produce something, and they don't really have a real plan. I just don't know.
Yeah.
And the thing I think is that no one knows, right? Because when you typically, and I've studied this quite extensively, is when you're looking at a new technology that comes in, whether or not it was the dot-com in the 90s, or it can go back to the railroads in the 19th century. There was a railroad bubble in the 1860s or so, where railroads were a new technology, and everybody was thinking, this is so revolutionary. We can move cargo in a week from one side of the country to another. We've never had it before. We needed horses. Right. And all of a sudden we can move all these things from coast to coast in just a week. And it's so revolutionary, and it's completely changing everything. And guess what? It did change everything, right? However, the initial response to the invention of the railroad was that every other person started a railroad company, and railroads were actually overbuilt compared to the amount of cargo that could actually be shipped on them. And they were so overbuilt, most of them couldn't make a profit because there's just so much for the cargo companies to pick from. And the rates went down massively, and it was just overbuilt compared to the demand that was there. And everyone realized it all at once, and all these equities collapsed. Now, that's something that happened over and over and over in history, in different things.
And actually, I recalled I actually got it backwards. The stat from the analyst, and it was a Sequoia analyst. They basically said the 600 billion is actually the amount of revenue that would need to be generated to justify the hardware expenditure that's currently being made. So it's basically saying, like, if you work backwards, sort of here's how much is being invested. It's because it's CapEx, right?
Right.
Here's how much revenue is needed, and so then it leads to the question of, okay, well, where is this 600 billion revenue going to come from? So I guess that's the question. We'll see.
So the multi-trillion-dollar question is this overbuilt like railroads? Because that happened also in the dot-com bubble. That happened in many others. Usually when a new technology comes in, revolutionary, changes the way of thinking, changes everything. And usually what's funny enough is that it actually does change everything. But people price in 20 years of growth in a year or so, and that creates that mismatch between expectations and reality. But again, no one really knows at this stage how early we are in that or not, right? That's kind of the big situation, the big question. And here we are seeing, expectations are for some kind of decline there. And it is a very important question. Why? Because we talked extensively about this idea of lost decades, things like that. And if you bought the NASDAQ in 1999, you wouldn't make your money back for 14 years. Why? Because you actually had a 90% drop. 90% drop, you actually need a 10xer to get back to where you were. This move here is a 10xer, which is hard to see, but it actually was. And then after that point, you have a 5x your money between then and now, which was roughly from 2013. And so the last 11 years or so was at 5x. So again, people say you can't time the market, but at the same time, if you buy at the wrong time and go through a 80, 90% drawdown, that's quite painful and your money is dead for a very long period of time. So very important to understand. Talking about some of the cash situations. So one of the big arguments that I keep hearing over and over again is that, yes, but now there's a lot of cash on the sidelines and that can continue to fuel markets as interest rates come down, which are likely to happen at some point in the future. And then when that happens, money is going to flow into all these things. Turns out that cash amounts are actually quite low. They're actually the lowest they've been since roughly the dot-com era 2000. And I think it's kind of interesting because we're in a much higher interest rate environment. You can see the post-Lehman period. That's when we went into zero interest rate environment. So it makes sense that you'll have way less in money market funds because we had what's called TINA. There is no alternative. There's no alternative to equities. You have to buy equities, but there's a big alternative now. You're making 5% plus in a risk-free instrument, supposedly risk-free instrument. So you would have expected this pre-Lehman type of larger allocation to come back, but they have not. So the FOMO mentality that was ingrained post the GFC, with the market always going up, is still there, which makes it kind of difficult to get more cash. And in this chart, you can see that the equity allocation is actually very, very close to what it was in the dot-com bubble period in 2000. And curiously enough, cash and debt levels are quite low as a percentage of a portfolio, despite the high rate environment.
Yeah. And we talk about this obviously in our deck. It's a big part of our investment thesis and why absolute return is so important. Because when you're so reliant on equities, it's a dangerous formula with everything that you just demonstrated in terms of like how narrow the market is, like how much room is left to melt up. That's really the question, and yet it's going to impact so many portfolios.
That is the very big question, and that's why I thought this chart was kind of interesting. There's this conventional wisdom that rate cuts are bullish. What is bullish is the expectation itself. So what's funny is when people think rate cuts are coming, they bid the markets up historically. But when the rate cuts actually come, they usually come because there's some level of a slowdown in the economy, inflation, and the employment market starting to deteriorate, something we're seeing today with jolts. And, we're seeing a lot of leading economic indicators, things like that. So when the actual cuts come, the market typically doesn't do that well. Here, this chart of the S&P goes back to 2000, and you can actually see over here that on the left side, when the first cuts come in 2000, the market goes down. Obviously, the dot-com bubble kind of blew up. 2007, you can see that the global financial crisis happens. And even during COVID, the rate cuts led to some severe market drop. So the biggest, you can see this kind of split there on the chart, AI on the upside and then crash kind of on the downside. I think it is a big question whether AI is real, because if AI is real, even if we go through a slowdown in the economy and kind of a recession, if productivity boost is real, that could push the markets even higher, right? If this becomes more of a, earnings growth, you don't necessarily have to correct for the rich valuations by prices going down. You could just improve earnings. So if there's a big productivity boost, that is something that can happen, right? That's really the big question. And we are getting much closer to the beginning of the rate cuts, as evident by a lot of what the Fed is saying. Probably going to start this year at some point, maybe 2 or 3 cuts. Is it going to be September, November? That's kind of unclear, but rate cuts are likely coming.
Yeah. Well, and I'm curious, like, even with that productivity boost or the potential for it from AI, the question is, will it be too little too late? Meaning, like, we could go into a crash that could last a number of years. Then we start to see the productivity gains, and that's really what drives the next bull cycle. But, could that be a number of years in between?
I mean, that's similar to what we saw in the dot-com era, right? We saw the markets crashing, and then the productivity growth happened eventually, and it took some time for that to happen. And then we obviously inflated a real estate bubble on top of it when rates went down in response to the dot-com crash. So that's kind of a different situation. But yeah, I mean, anything is possible. I obviously lean into this time is not different, but I've been wrong before, so it's something we want to watch.
Yeah, makes sense.
Okay, switching gears a little bit there. We're looking at the earnings revisions and things like that this year. So let's talk a little bit about earnings valuations, things like that. So earnings have been improving for the top 20 companies. Again, it's a little different in the dot-com era where things were not really that profitable. And then everybody was just expecting profits to come in the future. This time is quite different in the way of the 20 companies are seeing earnings grow. However, all the others are getting earnings decline. There's negative year-to-date earnings for all, like the average company that's not the top 20, which is just stunning. So in a way, this discrepancy, this divergence is justified. Because companies are actually declining in their earnings power, as you can see, where the top 20 are not. They're growing quite a bit.
Yeah. Well, that's a whole that's like another component then, which is maybe the divergence is actually correct. I mean, it's a healthy and natural convergence.
Well, at the same time, though, valuations are very, very rich. So
yeah,
investors are paying for that. It's not free. It's not like they're buying any bargains, right? And talking about this, I want to talk about 2 separate things. The valuation as far as just the normal price to earnings ratio, which people are typically familiar with. You take the price divided by the earnings and you get some kind of ratio. And then we talk about the kind of Cape or Shiller ratio, which I think is a little more accurate because it looks at inflation measured by CPI. It looks at backwards earnings, and it doesn't have this volatility that comes with earnings decline or kind of like earnings going up in the cycle. So it's a little bit of a more accurate measure. And we can derive a really interesting ratio out of it, which gives us expected return in the future. So here you can see during prior peaks, both in 2000, 07, 2020, and 2022, where the normal forward P ratio was. It got as high as 25 in 2000, dot-com peak, with about a 6% treasury rate, 1.4% dividend yield. 07 only peaked at 15, which is quite interesting. 2020 around 19, roughly the same in January of 2022 as we are today at about 21. The biggest difference is that the risk-free rate and the 10-year treasury rate is far higher, which typically is something that should result in lower valuations, but we haven't seen it in this cycle. So as of the end of June, we're sitting at a 21 ratio, which historically is very elevated. And why does it matter?
Right.
It matters because it gives you an idea of what forward returns might look like. Here we're looking at Shiller P ratio, as I mentioned. It's sitting at about 37. Historical mean is roughly 20 to 25. And what we can derive from the Shiller P ratio is what the expected return is going to look like in the next 10 years. And historically, it's been very, very accurate, almost to the tune of about 90%. Now, we're not talking about 1 year forward return or even 2. We're talking about roughly 10 to 15. And that's derived from conditions today. intuitively kind of makes sense. If you're buying something really expensive, it has to kind of work its way into the valuation you buy it in, which results in lower returns. If you're buying something cheap, it doesn't need a lot in order to grow the valuation, which is why you would want to you always want to buy lower valuations and not kind of like the Warren Buffett mentality. Um,
Yep.
Implied future returns, this based on the conditions today, are only 2.2% going forward because the valuations are so rich.
Well, that definitely is a strong lost decade indicator. Um, but obviously we'll have to see.
Yeah, here's a measurement of how this is done over the last 40, even 50 years or so. So you can actually see both the 10-year rate and what it's traded in over since 1970, really. The expected return here in green and the actual return in blue. So you can see that it has traded fairly similar as it kind of comes in. And due to the conditions, the expected returns going forward are going to be quite low. But you can see there's right now, the real return is quite higher than the expected, sitting at about 12%, what we've seen versus the 2.3% expected. But we have seen periods like that, like right here in the early 90s, which we've seen very, very high returns. But that was due to the dot-com bubble. And look how that kind of compressed into even below the expected return, kind of like ebbs and flows as eventually kind of results to the mean. But that indicator is suggesting a lot of volatility in the next decade just because valuations are so rich today.
Interesting. Okay. So on, oh, go ahead.
Yeah, that's kind of the last thing about it. Again, if you get the perfect mean, you get kind of the 2.2%. However, if you do get the lucky scenario of kind of mean plus 150%, you could see a 7% return still of the S&P. But on the downside, if you get the mean at 50, it actually could be negative. So just kind of something to keep in mind.
That's interesting. Okay. So, I mean, hey, that really lucky scenario, you end up with the, what is one of the averages used for estimates of S&Ps for, returns, that average at 7. But again, I guess the question is, do you want to rely on luck when you can diversify? That's the question.
Exactly right. Lastly, before we finish here, because I know there was inflation for today, came in a little bit lower than expected, but core is still relatively high. It's kind of a big thing to determine when the rate cuts do kind of happen. So we can see inflation is come down a lot on a year-over-year basis, but it's still trending over 3%. With the Fed target is 2. Kind of the last mile has been very challenging and relatively sticky. A big part of it, honestly, why people don't really feel a relief, I think, is shelter. Shelter is still coming in at 5.4, 5.5. So think about it. Yes, it came down from 8, but now your rent is still going up 5.5% a year. So it's not going up 8, but still very material, right? So that hasn't really come down as much. And what's really interesting is that inflation expectations are going up. So over 5 to 10 year expectation, even though the ones for 1 or 2 have come down, consumers are expecting an over 5% inflation. It's actually the highest in 31 years. So even though CPI is coming down to 3%, expectations tend to create reality because of behavioral shifts. So if people think there's going to be inflation, they act in a way that creates inflation.
Yeah.
And that's pretty problematic, that now the expectation of future inflation is becoming ingrained in people's minds. When you're thinking about the next 5 to 10 years and you're asking a person, hey, what do you think inflation is going to be? They're saying it's going to be over 5%. And that's a big problem. It's especially a big problem as we're seeing a lot of macro trending lower. So when you're looking at economic surprises over the last few months, it's becoming very negative. Both ADP deployment, ISM services, things like that we don't necessarily need to cover. But we are seeing kind of a jaws of stagflation coming in, because on one hand, we have the inflation expectation continue to increase, but economic surprises are decreasing. Also explains why the majority of S&P companies are trending with negative earnings, but at the same time, we have this dynamic that we covered with kind of the AI trade. So very interesting set of facts and different types of back and forth that's happening in markets today. And as always, we're happy to cover them for you.
Yeah. Well, I'm glad we could get back into discussing markets together. And again, we want your feedback. we didn't manage to make it quite as short as we planned, but we're going to continue testing and experimenting with different formats as we bring you more information. We want it to be useful, we want it to be actionable, and we want to keep you informed. So with that being said, enjoy the rest of your July and keep enjoying your summer.
Have a great summer, and we'll catch you shortly.